Welcome. You're watching the Mutual Fund Show on NDTV Profit. I'm Tamanna Inamdar. This is the show which helps you make the right decisions on your mutual fund investments. Well, today we're talking about that one stock, that one sector, and that one focus that the whole world is talking about, and that's NVIDIA. Now, if you're sitting and wondering, well, it was good luck, or the lucky investors on Wall Street who can invest in NVIDIA, that's not really the case. There are quite a few mutual funds that have exposure to NVIDIA and other AI stocks, to FANG stocks as well in India, at least two directly and a clutch of them through passive investments. We're going to tell you a bit about that on the Mutual Fund Show today. We're also going to tell you whether this is the right time to hop on to that AI bandwagon. Does it make sense? How do you make that decision? So let's speak now with Ronak Onkar. He is fund manager and head of research at Parag Parikh Mutual Fund. I'm also speaking with Santosh Joseph. He is founder of Germinate Investor Services and is going to be our advisor for the day. Welcome to both of you. Ronak, let me begin with you. And the reason we were keen to speak with you is because Parag Parikh Mutual Fund is one of the early ones that have had an exposure to FANG stocks that have given Indian investors that opportunity. Let's start by getting a sense of how well that has paid off for Indian investors, why Parag Parikh first decided to go into funds like this, and right now, what is the kind of interest you're seeing for funds which have exposure to tech stocks on Wall Street, especially to do with AI?
Hey, thank you for inviting me. So we only have one scheme, the Parag Parikh Flexi Cap scheme fund, which is the one that invests in international stocks. And in that scheme, we have exposure to companies like Alphabet, which is the parent company of Google, Microsoft, Amazon, and also Meta, which used to be called Facebook earlier. So these companies were invested in our fund a while ago, essentially because they don't have equivalent companies in the Indian listed market. So if you wanted to find an equivalent of a Google-like company in India, we don't have an option, number one, even in the unlisted space. And in the listed space, we don't have equivalent technology companies here. Same applies to companies like Microsoft or e-commerce retailer like Amazon, or even a social networking company like Meta. So we wanted to invest and get exposure to these companies and also diversify from having a country-specific exposure to only Indian stocks. So at the moment, we have 15% of our portfolio invested in the global stocks that we own. And the idea was to geographically diversify and also participate in a unique business opportunity, which also is a good business to participate in.
Can you give us a sense? I know, Ronak, you don't want to perhaps talk specifically about any stock, but can you give us a sense of how some of these or this fund has performed over a period of time?
The fund has done reasonably well, and it's also on the back of the domestic stocks. So it's not just the international holdings that have helped us do well. If you see the history of the past 10 plus years of Flexi Cap Fund, we have had international investments right since inception. So sometimes when the international stocks would do well, the domestics will not do well. Sometimes domestic will do well, international will not do well. Sometimes both will do well or worse at the same time. So on an average, the performance has been the performance of the NAV that has been in the fund over the past 10 plus years that the scheme has been operational. And I don't mind talking about the specific stocks we own because these businesses we have discussed in public in the past as well. These are very unique businesses, like I said, and they have different buckets of exposure to the segment that you are describing, the AI segment you are describing. So we can discuss that further.
Okay, great. No, so then let's do that. I was under the impression you might not want to, because frankly, all anyone wants to know about is NVIDIA right now. And is this a way to get exposure to NVIDIA? Do you think it's too late? As a fund manager, have people missed the bus, or is there more to come, considering that their revenues have quadrupled and they have very strong projections ahead?
So since we don't own NVIDIA, I won't be able to directly give you an answer to that. But what I can tell you is, and your audience, is the idea to understand the AI market. I hope you have some time for that. Number one is there are three layers to it. One is the infrastructure or the hardware layer, where NVIDIA rests, and even the companies like Google or even AWS or Microsoft, they provide cloud computing infrastructure, which is required for running these AI businesses. The second layer, which is on top of that, is the actual models, which we hear from OpenAI or Google's Gemini or even AWS, Citon. So these kind of models which require a lot of computing resources, they are built on top of the infrastructure layer. And the third layer, which is the layer which we are exposed to as users, is the application layer. So it can be an enterprise software that we are using, or even a personal device or software which has AI components built into it, like a recommendation engine or a customer service support that we are seeing. So all these things are on the application layer. At the moment, what we are seeing is there's a huge buildup in the bottom of the pyramid of this, where infrastructure is considered. So you can see capex from all these cloud players going and benefiting companies like Nvidia, who have the specific hardware that they can sell for scaling up the infrastructure capacity. On top of that, when companies like OpenAI or even Google invest in creating their own models, they will have to consume this infrastructure on their own. And right now, you will only see a few plans which they are offering to customers to buy, where they can expose them to the APIs of the underlying models. And these APIs essentially become the usable part of the application layer. So we are not even seeing the application layer grow yet. And of course, in any technology, we can see the progression going up. So right now, we are in the curve where we are seeing the hardware and the models driving the demand right now, whereas the application layer is being built out slowly and steadily. So here we are. So if you ask about missing the bus, it's very hard to say, because we don't know how much hardware will be required in the future. We don't know how much investments will be sustained in the future. That is something we have to monitor.
What is your outlook for your fund?
So companies we are positioned with, they have exposure to both the layers, even all three layers. So we are okay. We are diversified across different players. So we are not betting our hopes on only one player doing.
All right. So that's that's a good sort of segue to talk about the next leg of this. And Santosh, let me come to you on that. Of course, Ronak, stay on with us. The question is now, how do you make the most of it? Is this the approach, a flexi cap kind of fund? There are some active funds available, I think only a couple really, and more passive funds available. Is that in a sense a good idea to go for? And your take on the Nvidia rush. Do you think enough Indian investors would have also participated in that?
Well, the first thing is that thanks to the sharp move that we saw last week, everybody wanted to check their portfolios to see, do I have Nvidia in my portfolio? And you know, if you actually watch some of the NAVs which had the potential to have US equities, you did see a couple of schemes which did have Nvidia, whether directly or indirectly, have a 3 to 3.5% blip in the NAV just on one day. The NAV just shot up about 3% in just one day, thanks to the 15% move. Now, the way an Indian investor can benefit from investing in Nvidia or Meta or the Microsoft business is, number one, in funds like which Ronak is running, where it's a domestic Indian equity fund, where they use the 35% limit that they have to take exposure to equities beyond the domestic market, which adds great value to the fund. Largely depends on the scheme objective and also the investor choosing them. The second is the fund of funds which have exposure to global equity, both diversified as well as thematic. Now, a classic example here is that Franklin Templeton has got a US opportunities fund where one of the top holding there is Nvidia, and therefore you see that NAV is giving you the highest return on a 3 days or a 7-day basis. Now, you also have a lot of passive funds, whether it's the FANG funds or even simply put by the NASDAQ ETF. So I think an investor need not fret or worry about missing out. Number one, Nvidia or any other fund. For example, over the last few months and almost a year plus, we have a lot of funds coming out of the innovation funds. Now, at the core of innovation, there is so much of AI and innovation-led technologies which are abundantly available in the US, where it's becoming critical part of the portfolio. So one, don't worry about missing the bus as far as Nvidia is concerned. Number two, it's easier than you think to get access to this. And number three, when you are in a good portfolio which has got access to these kind of technologies and strategies, you will benefit from Nvidia or the next Nvidia that's going to unfold.
All right. My question is, should we get on to some of these funds now? Because like you said, the 7-day NAVs are looking great. And this question for Santosh. And which of these would be the right pick as of this point?
Whether it is this fund or any fund, chasing returns is the wrong way to start by selecting the fund to begin with. Now, if an investor so desires that his portfolio construct requires international equity exposure, or the client knows what the international equity as a perspective can add to his overall portfolio, then I don't think time is a constraint. You can add it even now. But when you add that, you have to be aware of the risk. Simply put, that the market risk at one, like Ronak was just explaining, Indian markets perform differently, global markets perform differently. Within that, technology performs very differently. Over and above that, you also have the currency risk, which is at play now and then. There is no hard and fast rule that just because of big returns you can't add or you should add. I think it has to be done more so with a portfolio construct in view. I don't see a reason why you shouldn't add even now, though it's run up so much, as long as your portfolio can fit, as long as the fund can fit into your portfolio.
I asked you this question earlier, Ronak, but I'm just curious to know, are you recently seeing more excitement about your fund with FANG exposure? Or if you can give me a sense in the last few weeks, maybe since the beginning of the year, as this trend has picked up, are you seeing more interest coming in?
The interest has more or less been the same. We have mostly long-term investors. We have been communicating to them what our strategy is and why we are making our picks. So most of them are long-term investors with SIPs running for a while. So it's not a particularly different kind of interest that we are seeing today that we haven't seen before.
So you're seeing the same interest. Maybe it's because you don't have NVIDIA in your portfolio. That could be one of the reasons. It's all about NVIDIA. I know you explained the layers, but frankly, people are just, seeing that one stock. We're going to take a very short break. On the other side, we discuss what your options are. If you are a new investor, at what stage and in which profile should you look at some of these funds? And also, we'll be taking your queries. This is the section of the show where we take your queries that you have sent in to us. Those numbers on your screen in case you want to write into us. And Santosh Joseph today is answering them. He's founder of Germinate Investor Services. Santosh, thank you for staying with us. Now, our first query today is from Braj Kishore. He's 44 and he says, I've invested 5,000 as an SIP in the Axis Blue Chip Fund for the last 3 years. The total fund value is 1.5 lakh rupees. Since this fund has underperformed, I have decided to exit and start SIP in a new fund. How should I invest the 1.5 lakh corpus created from the previous fund, and what large cap fund would you suggest to start and SIP in? Is Canara Robeco Blue Chip Fund a good option? So very interesting query there, Santosh. I wonder what you think of it, because yes, people would go fund shopping. How long should you give a fund that you feel after a point is not making the mark?
Yeah, that's one of the most trickiest questions as far as staying a patient investor is concerned. But let me just address something over here. Having been in a good fund like an Axis Blue Chip Fund for 3 years, and especially in a good format like an SIP, I think he shouldn't have redeemed the fund. He should have kept it. Now, after having withdrawn the funds, going back to another large cap fund may not make great sense, because you see the last 2 or 3 years, the markets did well, but large caps have kind of been laggards in performance. Now, if you're going to remove money from large cap, which you've accumulated through a SIP, and go back to a large cap fund, you might experience a similar experience all over again. So maybe it's better to tweak your investment objective a little bit and possibly start looking at a flexi cap or a multi-cap fund where you have predominant portion as large cap, but you also have a little bit of exposure to small cap and mid cap. Therefore, you will not experience what happened the last 2 to 3 years where large caps underperform, whereas mid cap and small caps outperform the markets. Being in a little more homogeneous scheme objective like a multi-cap or a flexi cap will avoid the lack of patience that you just experience in Axis Blue Chip, and therefore give you a better return over a 3 to 5 year period. So if you're considering the Canara Robeco large cap fund, I mean, within their stable, I think it's better you can look at their multi-cap or flexi cap fund. I think you will do better for yourself considering you're making this as a lump sum investment.
Okay, just overview here, Santosh, on large cap funds, and obviously there are different parameters to check if something is underperformed, but in a sense, people are also going to look at how small cap and mid cap funds have performed, at least in the last year or so, and in comparison, large caps are perhaps lagging. Do you think that now is the time to give some kind of faith or put some kind of faith in large cap funds?
Well, you're right in that. When you look at performance, and relative performance is the most impactful one. So you have large caps, mid cap, and small caps. So you have an average smaller mid cap deliver in excess of 40% return as far as the last 1 year is concerned, whereas you see large caps underperforming even the index, some of them. Now, in this scenario, it is looking really good from a 3 year perspective that large caps have not done well, and one could look at a fresh exposure to large caps, considering that there's a valuation gap in large caps. It's also important to note that the rally in smaller mid cap, which has been so robust, may not always sustain. At some level, the rotation will happen. Large caps will come back, mid caps maybe take a back seat. So while we feel that because of non-performance of large caps as yet so far, there is a value opportunity out there. But I think one should also be aware that these things tend to rotate. And in both cases, in terms of a rotation case and even in terms of performance, large caps seem to be a lot more lucrative right now.
Let me take one more question. This is from Mr. Nair, who's 63 years. I found this question quite interesting, frankly. He says, I'm retired and would like to know which is the best hybrid or debt fund to get monthly or quarterly income of around 30 to 90,000. So quite a range there. And what amount do I need to invest as a lump sum or SIP, and for what period? Now, this is, I think, a good question because it's talking about something which gives you a consistent return. He also says, I also do options weekly for monthly income and have invested approximately 10.5 lakhs in the SCSS scheme. What would be your advice, Santosh, for Mr. Nair?
So for Mr. Nair, let's begin from the second half of the question. He should continue senior citizen savings scheme because it's a good scheme for senior citizens, and you have a kind of a defined yield coming in on a monthly basis, since the most important aspect of this query is that they like the month-on-month income to be coming. Now, as far as investment into the other fund concerns, whether it's a debt fund or a hybrid fund, I think today the choice is clearly between maybe an equity savings or a slightly conservatively managed balance advantage fund, and then choose to take initiate an SWP to ensure you get that income. Now here you optimize on taxes because both equity savings and balance advantage as a category give you equity taxation, and when you do SWP, even the withdrawal also is optimized for taxes. So as far as Mr. Nair is concerned, keep the senior citizen savings scheme, let that income come, make the rest of the investment into either a BAF, conservatively managed, or a good equity savings scheme. Ensure that the money is, the withdrawal rate or even the amount of money that you want to withdraw on a month-on-month basis is within that 5 to 6% annualized percentage of the overall investment, to ensure that you let your investments also grow and also meet your income requirements on a monthly basis.
Okay, so we have a few minutes left of the show and I want to pack in as many questions as I can. So Chinna is our next query, who's 32 years of age, says, for the last 1 year, I've had an SIP of 2,000 rupees each in 3 funds, the Canara Robeco ELSS Tax Saver Fund, the Mirae Asset ELSS Tax Saver Fund, and the Quant ELSS Tax Saver Fund. Should I invest in 2 to 3 funds from the same category, or should I invest in only one fund with good returns? Good question, Chinna. 3 ELSS tax saver funds. Santosh, do you think that makes sense?
Well, it is a bit much. One could have solved the problem, but I think I can see where Chinna is going. He's going with diversifying within the ELSS category, because whether you do 1 fund, 2 fund, or 3 fund, the objective of the tax saving category is to save taxes and optimize on return. But here I think he's done a bit of a smart thing by going in 2-3 selection. Now, also what I see interesting over here is these are very divergent styles, from Canara Robeco to Mirae to Quant. All the 3 are quite broadly placed in the spectrum. So I think, Chinna, you've done a good job for yourself. Though you could have just done with 1 or maybe 2 schemes, you've diversified well. So as your portfolio grows, it's nice to keep it diversified. And, this learning will be valuable for you.
Okay. I think there was a bit of self-awareness as far as Chinna is concerned, because they also asked, should I invest in only 1 fund with good returns? Just an overview on tax saver schemes. Do they make sense as, are mutual funds the right way to look at tax saving?
I think for this, the answer is an absolute resounding yes. Now, the first things first, you have to keep in mind that you have to use the old tax regime for these so that you can get the benefit of Section 80C. There are very simple points that help us figure out why this is the best. Number one, this has got the lowest amount of lock-in, which is only 3 years. You can do an SIP over here. You can diversify like how China is done into multiple schemes, because if you think the styles are different. And number four, when you compare all the available tax saving scheme on a 5, 10, 15, 20-year basis, again, a resounding answer that ELSS schemes have just outperformed every other avenue left. In fact, ELSS schemes are actually on par with some of the best performing funds in across categories, even in mutual funds. So as far as Chinna's thought process is, I think he's done a good job for both saving tax and for also optimizing growth of his portfolio.
All right. So it is a good idea in certain cases. Thank you so much, Santosh, for joining us today. Do send in your queries as well to us on the Mutual Fund Show. Those numbers, the WhatsApp numbers on the bottom of your screen, the more detail you can send about yourself will always help us get a more detailed answer for you, which could help you. So please do try and add all of that in your query. That's all the time we have today, but thank you so much for watching. Stay tuned. A lot more coming up on the other side on NDTV Profit.